Thank you all for being here, and please welcome the first group, Financing the Green Energy Transition.
There we go. So, 10%, it's a pretty small number, isn't it? That's what the IEA says that we need to spend on global GDP and capital to get us to net zero by 2050. 4 trillion, that's what it represents in dollars, much bigger number now. And how are we doing? Well, unfortunately, not very well. We're only hitting about 1.8 trillion a year. So there's a huge capital gap that we need to cross to get us to net zero. And that's where we come in. My name's Anthony Belcher, and along with my colleagues from Team Finance, we're going to be talking to you today about how we introduce capital, whether that's capital coming from government, capital coming from private markets, or indeed how we set those markets up to help support the transition to net zero. So I'm going to start off by talking about the aviation sector. So, aviation looks bad, doesn't it? It can't be all that bad. I mean, it's only 1% of global emissions at the moment, so it's pretty small. So it's not going to help us get anywhere. Why focus on aviation? Well, unfortunately, by 2050, it's going to be 9% of global emissions if we don't do anything about it. Combination of growing demand and abatement in other sectors means it's going to become a growing problem. Well, okay, so we've solved transport problems with other modes. Why don't we just strap a few batteries on the planes and away we go? No problem. Unfortunately, that doesn't work. The weight of the battery doesn't help us too much. And so we need to introduce new technologies that don't exist today at scale, whether that's sustainable aviation fuel or SAF or hydrogen. We need to come up with new ways of looking at it. And that makes aviation a hard to abate sector. So it's a global problem, right? So why do we care about it in the UK? Well, the UK is the third largest aerospace and aviation market in the world. Combination of the flights that we take and the industry that we host here means it's a particular UK problem that we need to solve. So can't we just leave it to the industry? The industry could be able to solve it itself. Well, unfortunately not. The aviation industry has particular aspects which may make it hard to work with. And so it needs an issue to look at the market structure. So how are we looking to try and solve these problems today? Well, first of all, and look at it from what I would call a barbell approach is how it's been looked at today. First of all, at a micro or a technology level, especially a lot of people here at Imperial are trying to address those hard to abate new technologies and bring them to industrial scale. Secondly, people are looking at this at a system level, trying to look at it top down, looking at a complicated problem and how to solve it. But unfortunately, what that misses is the bit in the middle, and that is the company level. What the research that currently is missing out on is understanding that the impact of these changes is having on the existing businesses that exist today and their own assets, and therefore with the risk of stranding of those assets as we make that transition. My research will focus on trying to understand what is a complex system rather than a complicated system and looking at and using new approaches to how we deal with that. I've looked at the UK narrow-body fleet. Narrow-body planes are those planes that we all use to go on short-haul holidays, single aisle down the middle, about 150 to 200 planes. I'm sure we've all seen them. And I've used a new innovative approach for robust decision-making to look at this, which involves an iterative approach, not just sort of quantitative model-based, but also involving qualitative interviews with industry experts to build and discuss that approach. When you've run through those scenarios and looking at different policy options and different sensitivities, you arrive at many different possible futures that can exist. What you can see on the chart here is each circle is a different possible future. The green ones represent those where we meet the carbon dioxide targets for aviation the government has set out. Red ones, not so much. The rings on the outside identify those where we have significant levels of impact or stranding on the existing companies that exist today. So in some scenarios, we're ending up destroying over 50% of current shareholder value. So what we see as well is areas where, for example, we've got scenarios where we need to bring more electricity than the current UK wind capacity, huge amounts of energy, causing a vulnerability to those futures. Or we've got scenarios where we need greater than 10% of our current croppable land dedicated to creating biofuels, or scenarios where we have greater than, as I said, greater than 50% of the airline share price loss. Clearly, a lot of these futures create problems, and as we try and understand our policies, this is where and how we need to think about policy development. So when I look at the key findings and the policy recommendations that have come out of this, first of all, when we think about demand policies, and primarily in the UK, that's a SAF mandate, blend mandate of how much sustainable aviation fuel airlines have to carry. Too low means we're going to miss our carbon targets. Too high means that we'll end up with significant asset stranding. So the UK government needs to increase its blend mandate to what I would call a Goldilocks level. Secondly, these engine replacements may drive significant demand for what's called PTL, or power to liquid fuels. Requires huge amounts of electricity that as we've seen creates problems for the UK. Therefore, the UK needs to look at this and work on a regional basis rather than a standalone basis. And then last, in the discussions I've had with industry experts, there have been issues around ensuring that we have long-term consistent supply side policies, and also that there may be a tension that starts to rise between climate policy and industrial strategy that may resolve and grow globally, creating geopolitics. So it's important that we make sure supply side policies are long term and are clear about what benefits they're bringing. My colleague Wale will talk a bit more about some of these policies about where and how we position government money to do that later on. So that covers one of our really new areas where we need to think about. Another area of nuclear. And with that, I'd like to hand over to my colleague Jeremy, who will talk about the nuclear.
Thank you, Anthony. And in the same area of policy framing and financing a sector of transition, I'm now going to talk about the UK nuclear program. So let's jump right in. You probably heard of the 2022 energy crisis. After gas prices surged, the UK government announced a large nuclear program aiming at reaching 24 gigawatts of available nuclear power capacity in 2050. So this is a very big announcement. Construction could cost 200 billion pounds, knowing that existing nuclear capacity in the UK is expected to phase out by 2030. So government released a roadmap in the beginning of the year to describe the nuclear program, but lots remains yet to define in terms of what technology is going to be deployed. Is it going to be traditional large-scale nuclear reactors or more innovative small modular reactors and new technologies? There is also uncertainty on when is it going to be deployed, at what cost, and who will finance it. So the point really of this project here is to put some strategies on the table to bring perspectives to those questions. The main challenge of the nuclear program to come is going to be financing. So depending on the country you're from, nuclear can be described as either a cheap or very expensive electricity source. The reason behind that is that nuclear costs heavily depend on the way you finance it. These are really large projects requiring large investment in the beginning over rather long construction times, meaning that a small change in interest rates can at the end double electricity prices. So to tackle this financing problem, the UK government introduced in 2022 a new financing framework for nuclear called regulated asset base. So under this financing model, investors earn a regulated return based on the value of their assets as soon as construction starts of the project. So this model has already been used in the UK to finance large essential infrastructures like water utilities, and by providing high certainty of returns and sharing mechanisms, it allows access to low interest rates, at the end lowering consumer prices. So what I did here is put 28 strategies on the table of different technology deployment, different government level support and type. Is it going to be direct investment or loan guarantees, for example, and of different financing frameworks. I evaluated those strategies over more than 400 futures, accounting for delays, cost uncertainties, integration in their energy mix, interest rate volatility, and in attractiveness to investors. Conclusions of these projects have been very different areas, and I'm going to describe two of those now. First conclusion, regulated asset base overall outperforms traditional project finance under certainty. So the explanation here is that regulated tariffs divide the risk to investors by 10 overall, meaning that investors agree to lower returns on their assets for this project. And at the end, lower interests reflect in lower consumer prices, even in the case where potential large overruns are partially shared with consumers. Moving on to the second and last conclusion of my presentation. If government is to be the main investor in the incoming nuclear program, and under a worst-case scenario where you can consider large delays, high costs, slow technology learning, government investment could amount to 0.1% of GDP per year over the next 20 years. So while this is a significant amount of money, which would impact UK debt levels in the midterm, this level of government investment is also similar to what is expected to be necessary for the transition of other sectors. And most importantly, it is lower than the cost of remaining reliant on gas technologies if future shocks and government response resemble the 2022 crisis. I'm happy to take questions at the end. And now moving on to Eduardo, who's going to talk about policy framing for carbon removal technologies.
Okay, thank you, Jeremy. Hello, my name is Eduardo, and I'll be presenting my research, which is part of the ongoing work of CORE, the Oxford-led consortium researching policy and business model dynamics for CDR in the UK. Carbon dioxide removal, or CDR, refer to technologies that remove and permanently store CO2 from the atmosphere. The immense scale-up of this sector in the UK is going to require mobilizing billions of pounds of private capital. To support this, the UK government are currently developing two policy interventions: the introduction of a carbon contracts for difference mechanism and the inclusion of CDR onto the UK emissions trading scheme. Now, the deep uncertainty inherent in scaling CDR implies that robustness becomes imperative in policy design. And there's currently a gap in the way that decision support inform policymakers on policy performance and, more importantly, resilience. So as a result, this research aims to assess the ability of various policy ecologies to attract capital investment to CDR, acknowledging the presence of this deep uncertainty. So let's go right to the chase. The first key message is that the policies the government is working on are going to be ineffective in attracting sufficient private capital investment to CDR. And the second key message is that private-public partnerships in various different forms are highly effective in attracting private capital and should be leveraged as tools to scale the sector. So the novelty in my research is in using an approach, a semi-quantitative approach that can assess policies based on both their ability to attract private capital and their robustness to deep uncertainty. So the qualitative part involved conducting a series of interviews with investors, and the quantitative part involved constructing a financial model to assess the performance of investments subject to different types of policy support. Key factors salient to the quantitative analysis, such as key uncertainties exogenous to investment decision-making, picked up in interview discussions and subsequently fed into the model. So these key uncertainties included the capital requirements of CDR investments, their scalability, the rate in which they can generate revenue, and various other policy uncertainties. These figures show the performance of investments in the same business model subject to two different types of policy support, where vertical axes represent metrics of investment performance. Each colorful line represents a future that is made up of a bunch of different combinations of uncertainties. So these results help decision makers unpack how uncertainty leads to varying investment outcomes and allows them to visualize the impact of policy support on investment performance. So the figure on the left shows investments, the performance of investments subject to the two policies the government is currently working on. By looking at the first column showing the internal rate of return, you can see that in very few future scenarios explored do investments perform well at all. So in other words, we need a very specific future to unfold in order for investments in this business model under this policy ecology to be, therefore highlighting a point of fragility within the policy. In contrast, if you replace this type of policy support and instead structure the investment around a private-public partnership, whereby government provides a low-interest loan, for example, investment performance improves significantly across the futures explored. So this table then summarizes the performance of investments in the 5 CDR business models I explored across 2 baseline policy scenarios. Percentages that are color-coded represent the frequency with which minimum investment requirements are met for different market actors, as you can see on the left. So on the left, you see a lot of red, which is bad because it signifies that in a scenario devoid of policy support, investment performance is essentially non-existent. Once you introduce the policy the government's working on, investment performance improves for most business models, but still the sector will struggle to attract the necessary capital to scale significantly. So once I understood that the government's plans to scale CDR were going to be somewhat fragile in the face of deep uncertainty, I tested various alternative policy scenarios, and these were tested under the same uncertainty parameters as before to ensure internal consistency. The key message here is that you can see a lot more green, which is good because it signifies that overall, these 4 policies are more effective in attracting private capital investment to CDR. And finally, qualitative and quantitative insights were combined to try and understand which policy ecologies were most suited to which specific business model. Overall, I can say that private-public partnerships offer a more customized approach to government support that combines public sector interests with private sector capabilities and offer a more robust policy framework. Now it's up to policymakers to take decisive action. Thank you very much. I'm going to pass on to my colleague Karl, who used a similar financial model on battery storage systems.
Hi everyone, my name is Karl and I will be talking about battery storage investments. Battery energy storage systems, or BESS, are transforming the future of energy by unlocking the full potential of renewables. Currently, 2.5 gigawatt hours of BESS are currently deployed in the UK, with 35 gigawatt hours of installed capacity expected by 2050. However, unlocking the required capital to fund these critical investments is dependent on the profitability of this asset class. My research is centered on analyzing this profitability by building a Monte Carlo-based BESS investment modeling tool where a key focus is placed on raw material prices. Battery storage systems, BESS, comprise numerous components, among which battery packs occupy the most significant cost contribution. Battery packs are themselves highly affected by the prices of raw materials, such as lithium, nickel, manganese, or cobalt, which are very volatile. You can see on this graph the relative price increase of lithium since September 2020. Since then, lithium has increased as high as 1,200%. Now, my model was developed in response to these rapid price fluctuations, the lack of standardized BESS cost structures across various research models, and the scarcity of academic BESS investment models. The model proposed consists of historic and current data on commodity prices, a bottom-up cell cost model that calculates the cost of components within a prismatic cell stack, which you can see here. The model also uses the most up-to-date BESS cost framework established by the US Department of Energy, and the multiple regression modeling approach is used to calculate cost for any system configuration. Performance parameters such as battery degradation or battery resizing are also calculated with this investment model. Now, a typical project finance model is also used, and modifiable assumptions are present, such as the capital structure or the revenues of BESS projects. The investment model is applied on Monte Carlo simulations for 24 different systems, comprising of, including 1 and 2 hour durations, 2 10 and 50 megawatt power capacities, and 6 different types of lithium ion cell chemistries, including LFP, that's lithium iron phosphate, and NMC stands for nickel, manganese, and cobalt. The purpose of this analysis is to unveil financial performance improvement levers while accounting for cost uncertainties in raw materials and in components. Now let's get to the results. The model enables a meticulous scrutinization of BESS capital and operational costs. The key findings are that lifetime cost decreases non-linearly with respect, increases non-linearly with respect to duration and power capacity. The LFP chemistry was found to be the cheapest chemistry due to much lower replacement costs compared to the NMC 111 chemistry. And the largest cost and most volatile cost was found to be the total storage block, which accounts for the initial and replacement batteries within the BESS system. These frequency distributions show how the investment model can be used through Monte Carlo simulations to simulate the returns and the costs of various BESS configurations. Both the unlevered internal rate of return on the left and the annualized capacity cost on the right improve with the following levers. Shorter durations, that's 1 hour instead of 2. Optimal chemistry choice, LFP instead of NMC 111, and optimal and larger power capacity, 50 megawatt instead of 10. To conclude, my research proposed a new model which shows how Monte Carlo simulations can optimize BESS investments. Now, my colleague, Paul, will talk about price cannibalization and how it affects revenues, which also strongly affects the returns that you see here.
Thank you, Karl. And I'll now focus on an emerging but critical challenge for mature technologies, and precisely revenue capitalization, which and its consequences on the revenue of offshore wind assets in Western Europe. So first, what is price cannibalization? Well, it is a consequence of the merit order effect, which observed that intermittent renewables lower electricity prices that they are producing due to their near zero marginal costs. And the problem is that the current fleet of offshore wind is concentrated in the North Sea, resulting in synchronized power generation. When one farm is producing, most of them are producing as well. And this lowers the electricity prices even further, sometimes leading to negative prices. And for producers with regulated tariffs or CFD, this drop has no effect on their revenues. However, with the rising cost competitiveness of these technologies, several subsidy projects are emerging, exposing developers to the fluctuations of market prices. On the other hand, some regions like the Mediterranean Sea and the Atlantic coast have also high wind speeds but are less developed at the moment and could be an opportunity. Therefore, the aim of the study was to investigate whether the geographic diversification could help mitigate price cannibalization, and put very concretely, could an offshore wind farm in the French Mediterranean generate more revenue than one in the North Sea? And to quantify this price cannibalization, we use a metric called capture value or capture factor, which measures the price of electricity captured by an asset compared to the average price of electricity. And if you followed, you expect it for offshore wind to be below 1 and to decrease with increasing penetration of renewables. The study was in 4 steps. First, study the synchronicity of all those assets across Europe, then analyze their historical evolution of capture value. In the 3rd step, I built a supervised machine learning regression model to model this capture value, which is ultimately used to do projections towards 2050. So first, the cross-correlation analysis conducted on 29 locations revealed that Europe possessed a wide range diversity of wind patterns, which can be grouped by sea basin, highlighted through clustering. And the second information is that countries like France show highly uncorrelated locations with all the rest of Europe, namely Mediterranean, while another country like Scotland have only highly correlated locations. And these differences in wind pattern, they have a consequence, clear consequence on the evolution of capture value. As you can see on the top, the wind farm in the south of France would have been the only one not affected by price cannibalization, while the rest of Europe would have suffered from decreasing capture value, with Denmark being the most impacted, but it had the highest renewable penetration. We go from beyond those qualitative calculations. I use this model, which would explain 84% of the variability in monthly capture values, with 70% of it explained by only 3 variables. First, the renewable penetration. Second, the synchronicity of the asset with load. And third, the synchronicity of the asset with the rest of the renewables. And those 2 last factors acting as modulating factor, guiding the sensitivity of each asset to the cannibalization in the country. And finally, using this model and projecting it in current national strategy, revealed that wind farms in the Mediterranean Sea at the top of the French range would have faced far fewer risks of cannibalization and higher revenues and capital value above 0.9 until 2050. And conversely, densely concentrated areas like the North Sea would face really higher risks. And with its increasing cannibalization, the financial incentive to couple the asset with either battery energy storage or hydrogen production will only grow, a topic that I'll let Mo present.
Hi everyone, my name is Mohamed Elgadal, and we're going to continue on the subject of price cannibalization mentioned by Paul, focusing on optimizing solar plus storage asset in the UK in collaboration with Mangin Energy from the private sector. With 17 megawatts of installed capacity of solar, the UK is highly vulnerable for price cannibalization, and with the risk of achieving less revenue compared to conventional sources of energy. The market is already moving towards co-location to mitigate this risk, with solar plus storage project skyrocketing in the first quarter of last year. The market is experimenting with the emerging concept of hybrid PPA to finance this new type of asset. Our project is trying to investigate how the optimization of solar plus storage can mitigate price and capture risk under hybrid PPA scheme. The project case study focuses on a specific location in the southeast of England with 38 megawatts of solar coupled with 10 megawatts of battery. And to ensure real market condition, 30 megawatt grid connection limit were introduced in addition to dynamic corporate demand profile. Data were collected for the last 5 years. First, we analyzed the historical day-ahead electricity prices for the last 5 years, filtering great area of high abnormalities that highlight the escalation of the Ukraine war and the European gas crisis. Representing the data on hourly basis for the last 2 years can clearly show how solar is pushing price down and how solar is pushing price down during sun peak hours. Then we use that historical pattern to forecast the day-ahead electricity prices for the next 10 years of the PPA contract using long short-term modeling forecast. The model objective function try to maximize revenue while minimizing penalties associated of not meeting the daily energy quota outlined in the PPA contract. And the main constraint is the battery capacity, power limit, grid limit, and constraining the battery to performing up to 2 cycles per day while prioritizing charging from the grid. The innovation of the model is optimizing the hybrid system on hourly basis for the entire 10 years of the PPA contract, while accounting for arbitrage and grid charging that could be shown in red color. The result shows high variation in seasonality, with low grid charging during summer. For the 2-hour system, the revenue increased by 8%, capture factor by 15%, and benefits around 260K per year. For the 4-hour system, the revenue increased by 11%, capture factor by 26%, and while penalties dropped by half. The net positive value remained negative due to the high capital cost associated with utility scale batteries. It's also worth mentioning that during low solar, the model showed 300% increase in weekly revenue compared to solar-only system. The capture factor result shows that for the 2 hybrid system, the 2 scenarios are outperforming the market constantly for the entire 10 years of the PPA contract. To summarize the impact of the HPPA model on the project main stakeholder for the off-taker, the system is providing more firm and reliable shape profile, reducing price and volume risk. And under the 10 years PPA contract, the net positive value is negative for the two scenarios. However, if the system can maintain this level of profit through the lifespan of the solar, the return of investment for the investor can be highly attractive. Finally, for the developer, the model significantly increase price and capture factor, revenue and net profit, with the potential of exploring additional revenue stream by participating in the capacity market. More on the capacity market with our next project with TORS.
Thank you all. Gaining insight into battery storage and value capture and policy design. Let's combine all this into the comprehensive project. Today, I will present the last project on optimization model for revenue enhancement and penalty mitigation in balancing services market. With the rising amount of renewables, the demand for balancing services has increased, such as one of the most successful ancillary services in UK, short-term operating reserve, also known as STOP. It involves two key windows. First, availability window, marked in blue. It represents the standby period when generators are ready to provide electricity if needed. Second, utilization window. Shown in red, it shows the actual delivery window when generators actively supply electricity during the specific store event. Generators receive both availability payments for being available, even not being used, and also utilization payments for actual delivery. So in order to maximize the profits, it's crucial to determine the optimal capacity to offer during each store event. Knowing the maximum generation capacity and the set demand during the store event, it allows us to calculate the actual delivery XACT. And when XACT matches the obligated capacity, there's no penalty. However, the set demand can vary significantly. If set demand increases and the actual delivery falls below the obligated capacity, there are penalties shown in the gray box. Obviously, maximizing profit also requires minimizing penalties. Let me introduce my advanced model to determine the obligated capacity to offer. What makes my model stand out is two-step methodology. First, simulation. I use K-means clustering to accurately forecast the set demand, and also adopt a probabilistic algorithm to randomly select the store core during availability windows. Second step, optimization problem. I formulated and solved the optimization problem with a mixed integer nonlinear programming, which considers two scenarios. First, without BAS and with BAS. The objective function for the first scenario is to maximize profit and minimize penalties. However, the later scenario also considers the trade-off between the BAS average and the cost of ownership. Let's move to the model results. Traditionally, power plants always use a deterministic method to set the bid at the difference between maximum generation capacity and the maximum site demand, which avoids penalty, but too conservative. The proposed method adopts a more dynamic strategy by bidding at a slight risk and the higher optimal capacity to offer. The results show that despite incurring penalties, it would the availability payment by 24.5% and the utilization payment significantly by 150.1%, leading to a 40% increase in the total profits. Additionally, for the second scenario, I also examined the average potential for BECS. The BECS are charged during off-peak hours when electricity prices are lower and discharged during peak hours and stop, releasing the pressure of generation. As shown in the diagram, the x-axis shows the different capacities of the storage from 150 kilowatts to 450 kilowatts. As shown in the diagram, the optimal capacity and the availability payments increased by 11% and the utilization payments by 8%. Conversely, the total payments decreased by 77% and the fuel cost savings soared by 233%. Resulting in an increase of 31% in the total profit. In conclusion, this research introduced an advanced model that determines the optimal capacity to offer and maximize the profits and minimize the penalties. Now let's welcome my colleague Elgadal to give the conclusion and take the questions.
Thank you very much, Doris. So, in closing, the insights shared today underscore a critical message. The financial sector holds the key to unlocking our climate goals. It's not just whether we can finance the green transition, but how we choose to do so that will determine the speed and success of our efforts. By fostering collaboration across sectors, creating stable and profitable investment environments, and by developing clear and robust policy frameworks, we can unlock the capital required to drive the clean transition to usher in a sustainable future forward. Thank you very much for listening. We'll happy to take questions.
Thank you for the presentation. I have a question regarding the 24 gigawatt. Is it based on what type of production that needs 24 gigawatt for 2050?
So the aim is a power, so it's a capacity. But then it should represent 25% of electricity generation in the UK in 2050, based on nuclear. But then there's a big question on renewable penetration and at what capacity is nuclear going to be operating. And if, for example, SMRs that are going to be more flexible operate at a lower load factor, what is going to be introduced to provide more flexibility? And there are several technical solutions. You can produce hydrogen when you don't need electricity, or connect SMRs to direct air capture. But so the government target is in the capacity, and it was based on an assumption that it should be 25% of electricity production in 2050.
Thank you very much. Thank you very much for the presentations. I thought they were fantastic. I just wanted to see a lot of they're obviously all interrelated, these governed by finance, but the end presentation I could see that wasn't perhaps totally affected by the cost of storage was perhaps with the airline industry, where you have to sort of come with completely different types of synthetic fuels and not really related to current sort of battery technology, or sort of battery technology is perhaps within the sort of the near term in terms of being produced. But that cost of storage seems to underpin nuclear and how attractive that will be in the future, offsetting in terms of sort of wind sites, all of those sorts of things. So I just wanted to get a sort of a sense of how robust are these findings towards new technologies within the battery sector, which does seem to sort of impact everything.
I can start from the aviation industry, I guess. But you're right. From the aviation perspective, as I think was pointed out by Paul, the excess energy can either be stored or it can be converted into other energy to be used later, which is essentially the same thing as storage. So whether you convert it into a electrical battery, or you convert it into hydrogen or other new fuels, you're essentially converting and time shifting the energy around that. But I think your question around what or how different battery systems can perform in the future Maybe Karl, you want to, I'm not sure the mic, but it's working.
In terms of my research, my model has focused on utility scale batteries, so not co-located with other assets. So that's something a bit different because then you look at different sort of revenues and operations and battery profiles. So it depends really on specific models can be applied in specific applications, and that's what I looked at in my model. Maybe someone else want to add something about co-location or.
Yeah, I could say in terms of utility scale batteries, the capital cost is still hindering the profitability of the project. And as mentioned by Karl, it still depends on each scenarios of each model and the type of constraints. We cannot say for certainties the forecasted market condition, how it's going to affect the cost of utility scale batteries, but for sure, the levelized cost of storage need to come down.
Time for one last question if there's a.
Sorry.